Good morning or good afternoon, wherever you are, and welcome to the latest in the Russo-British Chamber of Commerce webinar series. Today, we're going to look at the sometimes opaque and ever-evolving area of UK immigration and tax structures for both businesses and the individual. My name is Alf Torrance. I'm the Executive Director of the RBCC, and today's speakers are from Dixcart UK, a well-known consultancy that provides a broad range of expert advice on tax, legal, and accounting issues. Dixcart have an international footprint with 10 offices in 7 countries. I'm delighted to welcome Paul Webb and Vincent Chung, and we're very grateful to you both for taking the time to be here today. Thank you as always to all RBCC members and friends for joining as well. Before we get started, I'll just run through the ground rules. After I've finished, Paul and Vincent will make 2 short presentations. I'm sure many of you will have questions to put to Paul and Vincent afterwards, so please use the hands up function on the Zoom app. However, by far the best way of getting your questions heard is to use a chat room function. Myself and the team will be monitoring it and we'll pick out the more popular themes. Most importantly, unmute yourself obviously when you ask a question, and then remute when you finish. As always, we'll record the webinar and post it on the website afterwards. Dixcart have kindly agreed to make the presentation available should you wish. And of course, you're very welcome to follow up any issues with Dixcart on a one-to-one basis. Contact details are on the website, or of course, available from us as well. Paul, as I said, very warm welcome to both of you. COVID-19's turned the world upside down. How's it impacted what you're doing at the moment?
Thanks, Alf. It's been a difficult time for us, as I'm sure it's been for many of you out there. Obviously, the lack of face-to-face meetings has been something that we've really felt. Part of what we basically do is we get out there and we meet people, and obviously that's not been possible. From a UK perspective, we're slowly, I think, starting hopefully to emerge from the shadow of the virus, and we're definitely starting to see some positive signs in terms of inquiries that we're receiving, and actually in terms of interest in the UK in terms of immigration. And what we're trying to focus with our clients now is the way forward. So, you know, the virus has hit, we've had that, it's a terrible situation, but what we really want to do is help guide people in terms of the next steps and the ways that they can take both their personal situations and their business forward. Just to say again, good morning to those of you in the UK, and indeed good afternoon to those of you in Russia. And I hope that you, your families and colleagues are well, and indeed that your businesses are managing in these difficult times. As Alf said, my name is Paul Webb. I'm a director at Dixcart International, and I'm joined today by my colleague Vincent Chung, who is solicitor at Dixcart Legal. Very briefly about the Dixcart Group. We're an independent family-owned group. We were formed in 1972, so almost 50 years old now. 10 offices in 9 jurisdictions, and a list of where our offices are located are set out on this slide. You'll notice we don't have an office in Russia. However, my colleague Maria in our Malta office is regularly in the CIS countries and is a fluent Russian speaker. So if there are any situations where you need advice from us, or your clients or colleagues need advice, and the language is possibly an issue in English, we can facilitate that in Russian where required. A very brief overview of what we do as a group. Effectively, our services range from private wealth to corporate management, immigration, citizenship, residence, right through to yachting, shipping, and aircraft registration. So it's a very broad brush. Not all services are provided from every office. I'm sure you'll understand the reasons for that. But generally, yeah, there are a lot of areas where we can help people with. In the UK, we are a mixed accounting, legal, tax, and immigration firm. And again, I've just laid out there some of the areas that we are currently helping clients on. In terms of today's presentation, as Alf said, we'll be talking about UK immigration and UK taxation. My colleague Vincent will talk you through the UK immigration aspects. And in particular, there have been some recent changes to the legislation, which hopefully you'll find of interest. And then from a UK taxation point of view, I'll talk to you about personal and business taxation, but probably most importantly, one of the areas that I'll focus on in a bit more detail is the remittance basis of taxation, which could potentially mean that the UK can be a very tax advantaged jurisdiction for certain clients, such as Russian individuals who are looking to take up tax residence here. So without further ado, I will pass over to Vincent to talk to you about the immigration aspects.
Thank you, welcome everyone. My name is Vincent Chung, and today I'm just going to give you a general overview about some of the visa options that are more popular and also lead to applicants being able and eligible to apply for permanent settlement once they've met the requirements. So the first category that I'm going to just touch on is a Tier 1 investor visa. As you'll see on the screen, that's generally an option that's available for applicants that have a minimum of £2 million to invest in the UK. The funds will generally need to have been held by the main applicant or by their partner or jointly for a minimum 2-year period prior to the date of the visa application. Or if you've not held the funds for a minimum of 2 years, then it is possible to use funds from other sources, and you'll need to provide evidence of that. So other sources would include, for instance, if you've been gifted the money, if you've inherited money, if you've sold business assets, for instance. Those would count as long as you can show the source and that it's backed up with a letter from a qualified legal advisor. As I mentioned, it's necessary for the funds to be freely transferable to the UK. So your financial institution may need to provide a letter confirming that the funds are not subject to any exchange controls. So the Home Office, the UK authorities are just more concerned that the funds should be legally acquired, and that's why we need all this evidence. It's also necessary to provide evidence that you've got a UK regulated bank account opened for the purposes of making a minimum investment of £2 million. And the investments have to be made into qualifying UK investments within 3 months of either getting the initial Tier 1 investor visa or within 3 months of your entry to the UK. There are rules as to what is a qualifying UK investment, and that is share or loan capital in active and trading UK registered company, and there are exclusions as to what the funds can be made into. So your investments cannot be made, for instance, into property management companies, property investment companies. But if the company deals predominantly in construction work, then that would be acceptable. With the Tier 1 investor visa, your partner, such as your spouse, your civil partner, your unmarried partner, same-sex partner, and any children under 18 can also apply as dependents. Children that are under 18 but are close to turning 18, they will have to make sure that their dependent application is submitted before they turn 18. If they turn 18 before they submit the dependent application, then they will need to apply for an appropriate visa in their own right. Under the investor visa, there's no English language requirement, and there's no requirement to provide evidence of maintenance, but it will be necessary to provide criminal record checks for the previous 10 years for any country you've been present in for 12 months or more. It might also be necessary to provide a tuberculosis test from an approved medical centre, depending on where you're applying from. And With this visa, the initial visa is normally granted for a 3-year period, or just over 3 years, and then it's possible to apply for an extension of 2 years. And then after 5 years, it is possible to apply for indefinite leave to remain or permanent settlement. It is possible to apply for indefinite leave to remain after a period of 3 years if you're investing a minimum of £5 million, or you can also apply for indefinite leave to remain after 2 years if you are investing a minimum of £10 million. The next visa category that I'm going to touch on is the sole rep visa, or more formally known as a representative of an overseas business visa category. This has become a more popular visa category as the Tier 1 entrepreneur visa category was closed to new applicants last year. It was 29th of March 2019. But the sole rep visa has always been in existence, and it's for a senior employee in an overseas company who will have the full authority to be able to come to the UK and be sent by the parent company to the UK to establish its first UK presence. So for instance, as a UK branch or a wholly owned subsidiary. And one of the more recent rule changes is that the the senior employee that's coming over to the UK, they cannot be a majority shareholder. That's always been the case. So majority being 50% or more. And they can't, one of the more recent rule changes is that that you can't have control in the overseas company, or you can't have control of more than 50% of the voting rights in that overseas company. And that, as you'll see on the screen, that rule change came in on the 10th of June 2020. The applicant will need to have the necessary skills and experience and knowledge. And as I mentioned, they will have to have the full authority to make the decisions in the UK. One other thing that I will add is that the shares in the UK company, 100% of the shares will need to be owned by that overseas company. The senior employee will not be able to hold any shares in the UK company. As with the investor visa, your partner and children under 18 can also apply as dependents. The dependent, and this is another rule change from the 10th of June 2020 onwards, and the dependent can't be a majority shareholder, and they can't have control of more than 50% of voting rights. So historically, or prior to the 10th of June 2020, it was possible for the dependent to hold the majority shareholding, and the main applicant, the other partner, come as the main applicant, and both the partner and dependent could come to the UK together. So this new rule change means that both partner and dependent can't have a majority shareholding and can't have control of more than 50% of the voting rights. And I would add that if a partner can't come to the UK because of the majority shareholding, then unfortunately the children can't come to the UK either. And that's just one of the rules that apply. Again, there's a need to meet the English language requirement, and there might be a need to provide TB test results. It's also necessary to provide sufficient funds as evidence that you'll not be a burden on the state. The Home Office don't specify what is sufficient funds, but we normally suggest showing evidence of bank statements or perhaps payslips from the last 6 months. That will normally be sufficient. And again, it's usually possible to apply for indefinite leave to remain after 5 years. So you'll get an initial 3-year visa, and you'll be able to extend that for a further 2-year period. And then the last visa category that I'm going to touch on is the Startup and Innovator visa. These came into effect from 29th of March 2019, and as I mentioned earlier, it's in part or mainly because the Tier 1 entrepreneur visa was closed to new applicants. So in effect, these two visa categories replace the Tier 1 entrepreneur visa category and Tier 1 graduate entrepreneur visa category. As you'll see, if you're applying from the outset for a startup visa, there is no initial capital required. If you're applying for an innovator visa, then you need to provide evidence of a minimum of £50,000. If you're going from a startup visa to an innovator visa, then you don't need to provide any initial capital. For this visa category, it removes the business consideration aspect from the Home Office and places that onus on the endorsing body. So there are a list of approved endorsing bodies who will assess against Home Office criteria, which is innovation, viability and scalability. So the endorsing body will discuss with you and assess your business idea, ensuring that it meets new or existing market needs and or it creates a competitive advantage, and that's the innovation criteria. The viability criteria is that it's realistic and achievable based on your available resources. So if as part of your business plan, you're saying that you will, you know, a lot of your capital will be raised in the UK, an endorsing body may see that you don't have available resources, and so that may be an issue. Whereas if you've got already a lot of your capital and you just need to raise a bit more capital in the UK, then it's likely that the endorsing body would consider that your business idea is viable. And the last criteria is scalability. So that's the potential for job creation in the UK market and growth into national markets for a startup visa, and growth into national and international markets for the innovator visa. And I should add that it's essential to get endorsement from the from an approved endorsing body. Without the endorsement, you cannot apply for the visa. So it's part one of the process is getting that endorsement. And again, as with the other two visa categories, it's possible for your partner and children under 18 to apply as dependents. It is necessary to meet the English language requirement, and it's necessary to provide evidence of maintenance funds. So the Home Office define that as a minimum of having held a minimum of £630 per person continuously for 90 days prior to the date of application. And again, TB tests may be required depending on the country that you're applying from. And again, it's usually possible to apply for indefinite leave to remain after 3 years on the innovator visa. So the innovator visa will be granted for 3-year periods, and you can just extend for further 3-year periods, or just after the initial 3-year period, you can apply for indefinite leave to remain. The startup visa is granted for, I believe, up to 2 years, but none of the time spent on the 2 years will count towards the 3 years you need to make up on the innovator visa. So in effect, if you spent time on the startup visa, you'll need to restart your time, as it were, to make up the 3 years under the innovator visa. And lastly, about applying for indefinite leave to remain. generally. Each visa category will have their own specific requirements, and there are also standard requirements that apply to all visa categories. So you will need to meet the English language requirement. It may be at a higher level than when you initially applied for your visa. There's also a need to meet the Life in the UK test. And another main requirement is that you can't have been absent from the UK for more than 180 days in any 12-month period, any 12-month period in the qualifying period, so the time it usually takes to be eligible to apply for indefinite leave to remain. So it's quite important, and I do regularly, and I do always advise clients to be mindful of the number of absences that they will have from when they get granted their first visa, just to make sure that you know, when it comes to being eligible to apply for indefinite leave to remain, they don't fall foul of this residence requirement from an immigration perspective. And I believe that Paul will probably mention the residence requirement from a tax point of view. And finally, the last point that I would want to make is that dependents can't apply for indefinite leave to remain before the main applicant. And again, the standard requirements apply to all adult dependents. So that brings this section of the immigration presentation to an end. If you've got any questions, please feel free to raise them now, or we'll take them at the end. And I'll now pass you over to my colleague, Paul.
Thanks, Vincent. If we can do the questions at the end, if there are any, that would be great. Thanks. So moving on to the taxation aspect. When someone's considering immigration to the UK, it's highly likely that they're also going to end up becoming UK tax residents. But for a lot of people, the UK can actually be quite a low tax jurisdiction, and that's due to the availability of the remittance basis. So the UK has concepts of residence and domicile, and both of which are relevant when you are looking at an individual's liability to UK taxation. So residence is concerned with physical presence in the UK, and whether or not you become tax resident here depends on the number of days that you spend here, combined with connecting factors. And connecting factors can include matters such as having available accommodation here, carrying out work in the UK, having a UK tax resident spouse. Technically, it's possible to be UK tax resident by only spending 16 days in any one tax year in the UK. That's an extreme example, but I think what it does highlight is that anybody that is spending a significant period of time in the UK, and by significant, I mean more than a few weeks in any one tax year, they really have to look and try and understand their UK tax residence position. It's very important that you don't become UK tax resident by mistake. The other concept that is important when looking at somebody's liability to UK taxation is the concept of domicile. And domicile is concerned with where an individual's home is. And by home, I don't mean the house in which they live. By home, I mean where they belong. And domicile is typically acquired at birth, and an individual typically takes the domicile of their father at the time of their birth. So if we take the example of a Russian individual, somebody who was born in Russia, somebody whose father was Russian, if they were to come to the UK, it's highly likely that they would be treated as non-UK domiciled at the point of their arrival in their UK. That can change depending on their intentions, but it is likely that their starting point would be as a non-UK domicile. And the reason why that's important is that UK tax resident individuals by default are subject to UK taxation on their worldwide income. However, a UK resident non-domiciled individual can claim for a special basis of taxation called the remittance basis of taxation to apply. And what that means is that they are only taxed in the UK on their UK source income, and there is then a further taxation if and only if they bring their foreign income or gains into the UK. So if they don't bring, or as we say, remit any of their foreign income or gains to the UK, they're not going to be taxable in the UK on those income or gains. So as I said in the previous slide, there is this special basis of taxation, and it can limit the liability to UK taxation for non-dom individuals. One additional point to make is that clean capital, and that's what we effectively define as pre-arrival income or gains, so monies that the individual had before they became UK tax resident, can also be remitted to the UK free of taxation at any point. So this leads us to typically carrying out some structuring for clients who are coming to the UK. And a very basic but typical structure is to set up 3 separate bank accounts. The first bank account would contain the clean capital, so that is the pre-arrival income or gains. The second bank account would contain capital gains that are post-arrival overseas capital gains. And the third bank account would contain income, again, post-arrival income. And the reason why that we structure it in this way is that the clean capital can be remitted to the UK free of taxation. If then further funds are required in the UK, the order at which those funds can be brought in can be determined based on the separation of the accounts. And as you'll see, capital gains can be remitted to the UK if required at a 10 to 28% tax rate, whereas income can be remitted at a 45% tax rate. So by separating the sources of income and gains, it gives us the option to determine the most tax efficient way of bringing those funds into the UK. In terms of the remittance basis itself, it's effectively free of charge for the first 7 years that somebody is tax resident in the UK. Once somebody has been resident for 7 to 15 years, a remittance basis charge, basically it's a fee that's payable to the UK government, is required. And that fee is £30,000 to £60,000, depending on exactly how long they've been resident here. Once a non-dom individual has been resident in the UK for 15 out of the previous 20 years, they are deemed to be UK domiciled for all tax purposes. And that basically means that they will no longer be able to claim the remittance basis of taxation. So their worldwide income and gains will be taxable in the UK. And also, more importantly, probably their worldwide assets will be subject to UK inheritance tax on their death. So in terms of some basic planning tips that we look to advise people on in terms of the remittance basis, if possible, we look for the realization and the rebasing of gains to get a new base cost, and also to be able to provide that pool of clean capital. The segregation of the original clean capital from future sources of income or gains is essential. One thing to be aware of is the mixed funds rules. So basically, as soon as there's any mixing of funds, so let's say, for example, the original clean capital and future income were put in the same account, any monies that are remitted from that account to the UK, so brought into the UK, will always be treated as taxable in the first instance. So once you mix funds, you can't unmix them. And as I said on the previous slide, there is potential exposure to UK inheritance tax. So what we do recommend is people keep as much of their wealth outside the UK as possible to avoid unnecessary exposure to UK inheritance tax. Some general points on UK personal taxation. Our tax rates do go up to 45%, but remember, for non-dom individuals, such as the Russian individual who's coming to the UK, we have the remittance basis of taxation. Our capital gains tax rates on investments are 10% or 20%. We do have a rate of 28% capital gains on residential property, but generally those rates are relatively low. We have no tax on the sale of an individual's main residence, i.e. their home. We do, as I mentioned, have 40% inheritance tax, but for a non-dom individual, so somebody who hasn't been here for 15 years, that exposure is limited only to their UK assets. So that's why I said on the previous slide, we don't recommend people bring in assets to the UK if they don't have to. We do have inheritance tax reliefs for business assets. So typically that would be shares in a trading company. And it is possible to plan for somebody who is going to become deemed domiciled. So somebody who is approaching their 15 years of residence, we can plan with them to keep some of their overseas assets outside the inheritance tax net. And typically we do that via the use of trusts. The other piece of planning for those individuals is actually to leave the UK. And unfortunately, we don't like to see people go. But if somebody is approaching their 15 years, then we have seen in the past them looking for another jurisdiction or potentially returning to their sort of homeland. Moving on to business taxation, we have low rates of corporation tax. Our current rate is 19%, and Europe's average rate, I understand, is around about 22.5%. We have research and development tax reliefs. They're quite generous. They allow a deduction of up to 230% of qualifying expenditure, and it is possible to surrender any losses that have arisen because of this enhancement to the government and get repayable tax credits. We have a fairly generous capital allowance regime. So essentially, for acquisition of plant and machinery, we have a 100% write-off in the year of acquisition for up to £1 million of expenditure. We have various investment reliefs for fundraising. They can provide different benefits, ranging from income tax reliefs of up to 50%, to the ability to remit funds from overseas free of tax. So that would be non-clean capital funds. Quite interestingly, the UK has a number of dividend exemptions. So we have no corporate taxation on incoming dividends. And likewise, we don't withhold tax on outgoing dividends. So this does make the UK a potentially favourable jurisdiction to have either a pure holding company or a holding company for a subgroup. If you imagine the situation where you've got a number of underlying countries, no taxation, as I say, on incoming dividends from those companies, and then no withholding taxes either to the outward bound shareholders, be they individuals, or to outward bound shareholders as another corporate. And we also have a substantial shareholders exemption, which is very much like a participation exemption, which exempts from tax the disposal of shares in a qualifying subsidiary. And essentially a qualifying subsidiary is one in which the UK company holds a minimum of 10% of the share capital, and a qualifying subsidiary must be a trading company immediately prior to the disposal. I mentioned that we have a number of generous investment reliefs, and I think one again in particular for non-dom individuals is the business investment relief. What it does is it allows non-doms to invest into a UK business without being treated as a remittance. Now that business can be a third-party business, i.e. a pure investment, or it can be their own business in the UK. If the funds are remitted under this scheme, then if there is a gain on the disposal of that asset, the gain is tax-free, providing the proceeds are taken out of the UK within 45 days of the sale. And interestingly, for this purpose, commercial trade does include a business generating income from land, and that can be property development, but it also can be property investment. And property investment is quite a strange beast in the UK, and typically reliefs that apply don't apply to property investment vehicles. But in this case, you could, for example, have a property investment company. You could remit income from overseas into that company to fund the investments, and that would not be subject to UK taxation on the investor. This relief can also be quite interesting when you combine it with some of the other reliefs. So one of the other reliefs I mentioned was the EIS relief. EIS reliefs provide for a 30% income tax deduction on qualifying investments. So if you're able to combine an investment in a business that doesn't give rise to a taxable remittance, and you also then get 30% relief on your other UK tax liabilities, you can see how this builds a layer upon a layer and actually can provide quite a significant generous tax position. And then finally, I just wanted to touch on the research and development tax credits. It's one of the areas that we're doing a lot of work with clients on at the moment. And there's a bit of a misconception in terms of actually what is research and development. The, I suppose, archetypal example is men in white coats doing research into COVID vaccines, for example. But actually the definition in the UK is much wider, and research and development can include enhancements to business processes. We've done a claim for a bakery, for example, that enhanced its production line so that its output would increase by 10%. So it is quite a wide category, and the reliefs are very generous. So an SME business can claim up to 33.35% of their qualifying expenditure as a cash repayment from HMRC. And interestingly, the research and development itself doesn't have to be done in the UK. It could be carried on in an overseas country. So again, if you were combining the situation whereby you were using the representative overseas business to send an employee to the UK to set up a UK business, but that business was going to carry on activities that required research and development, that research and development could actually be outsourced back to the Russian parent company, carried out in Russia, but still qualify for UK research and development tax credits. So again, when you sort of delve below the surface of some of these reliefs, there are actually quite a few interesting opportunities available for overseas businesses and overseas individuals. So that concludes the presentation. Thank you for listening. We hope you found it useful. If there are any questions, Vincent and I will do our best to answer them. I believe Alf and Lewis are sort of in control of the technology and they'll facilitate that. If you'd rather email, then our emails were on the slides, and Vincent and I will be very happy to take any of your further questions via email if you wish. And yes, thank you once again for listening.
Paul and Vincent, thank you for a really interesting and detailed presentation. We have a few questions. If I may kick off, can I just ask you, obviously we're the Russo-British Chamber of Commerce, what visa scheme, and I appreciate it's hard to generalize, but what visa scheme do you see most Russians wanting to come in on?
We do find that the investor visa has been was fairly popular, but obviously with the sort of tightening of the rules to require the evidence of having held the funds for 2 years minimum, or being able to show the source of funds, we are seeing that they are turning to the sole rep visa and the innovator visa. It's slightly more onerous, but it is one of those options where they're able to come to the UK to set up a business, for instance, and to be able to sort of live and work in the UK. So, you know, we are seeing more popularity with the sole rep and the innovator visa, and that's one of the reasons why I covered those options today.
Great. Okay. Before I ask the next question, just let the audience, this is a great opportunity to ask two experts any questions you have. So please use the chat function, or as I said before, if you prefer to ask it direct, please use the hands up function. Okay, a question from Mr. Vardar. He's asking, has the £200,000 entrepreneurship visa completely dissolved or been revoked?
Yeah, so the Tier 1 entrepreneur category is closed to new applicants as of 29th of March 2019. So if you were admitted to the UK, or you're granted a Tier 1 entrepreneur visa before the 29th of March 2019, then you will still need to meet the £200,000 requirement as the initial capital. For the innovator visa, it is a minimum of £50,000. And like I mentioned, the startup visa has no initial capital. Depending on the endorsing body, they may require that you need more than £50,000. They may require you, for instance, to have £100,000 or £150,000. But the Home Office, the UK authorities, only require a minimum of £50,000. And I would add that you can have multiple applicants apply using the same business idea, and they would each need to have £50,000 capital for their own visa.
I think what seemed to be the case with the old entrepreneurs visa, so that the £200,000 requirement was that it was possibly being slightly exploited by people coming to the UK and perhaps not setting up truly genuine businesses. So as Vincent said, that is now closed, or was closed on the 29th of March last year to new applicants, and the innovator or startup visa categories are essentially the replacement, but the criteria for those has been significantly tightened, and we are now looking at genuine sort of innovative type businesses that are endorsed by a third party body.
Right, okay, thank you. A question on the same theme to a certain extent. Could you just talk a little bit more about the bodies that assess and endorse the three key areas of the business idea that warrants the innovator visa, and the process itself, please?
Yeah, so there are all different types of sectors who are approved as an endorsing body. You've got universities, you've got arms of banks, you've got just businesses themselves. We do find that a lot of the endorsing bodies are focused in the fintech sector. I would say probably half to the majority of the endorsing bodies are focused on those in the sort of tech sector. But that's not to say that if your business is not in the tech sector that you cannot get endorsement. You know, I was speaking with some endorsing bodies last week, the week before, and they were saying how they had endorsed, for instance, a hospitality business because they thought that it met the criteria, and the individual managed to get their visas. So there is no real limit as to what sector your business idea is in. Arguably, you will find that if you operate in the tech sector, you will have more endorsing bodies to choose from. But as I mentioned, there are quite a few endorsing bodies who will consider any business sector. And in terms of getting in touch or the process, you know, we are happy. We've got contacts with various endorsing bodies, so you know we're happy to sort of facilitate that that correspondence, that dialogue. We'll introduce you, or we'll have a chat with them on an informal basis, and they will normally let us know whether they think that it's something that they want to discuss with you more in detail. Usually it's necessary to provide quite a comprehensive business plan to go with that business idea, and that the endorsing body, that the business plan will be how the endorsing body will assess you on partly. They will also probably interview you as well.
My understanding, Vincent, is that there's effectively a list of endorsing bodies. And to become an endorsing body, they've either effectively, they've gone through an application process, and they're either experts in that particular area of, say, technology, or they've got a proven track record of assisting businesses.
Exactly, yeah. Under the entrepreneur visa, the business assessment was being made by Home Office caseworkers who may or may not have any business experience whatsoever. So with the introduction of the innovator visa and the startup visa, the business assessment is now the business assessment aspect is put in the hands of the business experts in their sectors themselves.
Which kind of goes back to what I said before in terms of one of the reasons why the entrepreneurs visa was closed, was that it probably wasn't being used for advancing UK business, and essentially that is why they've switched to this process.
Do you have a feel for what percentage of the business plans make it through the vetting procedure, so to speak?
I've not looked at the most recent statistics, unfortunately, but I'd be happy to send you an email to circulate round.
I think because it's sort of only just been over a year, and obviously part of that was interrupted by COVID. I think the sort of the data's difficult. I would suggest that, you know, again, if it's a genuine business, if the business works with experienced advisors, and as Vincent said, those sort of dialogues happen fairly early in the process with the endorsing body to get a sense of what the business is going to be doing, then obviously that's going to improve the chances of success remarkably.
Great. Okay, that question was for me out of interest, really, because it sounds quite
No worries.
it sounds quite a stringent procedure, and obviously it's quite, so even for a business expert, so I suppose it's quite
It is, yeah.
objective, really. Yeah. Okay, thank you. We have a question here asking you to expand upon the advantages of the UK investor visa over other investment options such as a St. Kitts or a St. Kitts and Nevis passport.
Well, for the investor visa, you know, as and when you get it, you will generally have the freedom to live, work, set up your own business in the UK. If you are looking to apply for indefinite leave to remain or ultimately British citizenship at the end, you know, if that is your goal, then, you know, the investor visa is one of those options that would allow that. As St. Kitts and Nevis passport, I believe that simply allows visa-free access to the UK for up to 6 months upon each entry, but you will never be able to apply for indefinite leave to remain or British citizenship on a St. Kitts, if you are not in an appropriate visa category, and that's what an investor visa would allow you to do. A lot of people look at an investor visa sort of for their family, for their next generation. So dependents will also be able to live and work in the UK. Children will be able to go to school and go to university in the UK. So that's why a lot of people prefer and look at an investor visa or another UK visa. So you know, it allows their partner and their children the opportunities that are not available simply with visa-free access, such as on a St. Kitts and Nevis passport.
Yeah. Okay, that's very clear. Thank you. Another question we have is, how long does the £2 million investment need to stay in the UK company? Can it be withdrawn after the visa is approved? And can the investor earn income from the company being invested in?
That's a really good question. The investment has to be, so as I mentioned, the investment needs to be made within 3 months of being granted the investor visa or within 3 months of date of entry to the UK. And it's important that you retain evidence of your entry to the UK. So make sure you go through the borders through a manned desk, and you'll get a stamp on your passport showing your date of entry. The investment itself, once you make it, it needs to remain for the full period that you're in the UK under a Tier 1 investor visa. And so if you're investing a minimum of £2 million, the earliest in which you can apply for indefinite leave to remain is 5 years later. So you need to maintain, the £2 million need to remain invested for that full 5-year period. It is possible to sell your portfolios. If you sell it at a loss, you need to purchase new qualifying investments at the same price that it was sold at. And equally, if you sell it and make a gain, you need to purchase at the price that it was sold at. The new purchases into the new qualifying investments normally need to be made within 6 months or by the next reporting period, whichever is soonest or whichever is sooner. And in terms of income, you can take interest and dividends earned on the portfolios after the date in which they were declared. Yeah.
So typically, we would recommend the clients work closely with a banking institution that really understands the subtleties of the investor visa. But in principle, yes, there's nothing stopping a qualifying share portfolio being invested into, and that portfolio generating income and returns for the requisite period. As Vincent said, that would be at least 5 years on the £2 million investment. That would decline to 3 years if it was £5 million and 2 years if it was £10 million.
Yeah, that's correct. And I would just add as well that I've not mentioned it, but it probably won't apply. But it was previously possible to invest in UK government bonds, but that option was closed to new applicants again on the 29th of March 2019. So if you got a visa, an investor visa prior to the 29th of March 2019, you can continue to rely on government bonds, but otherwise for new applicants since or from the 29th of March, it is just investments into active and trading UK registered companies.
Great. Okay, thank you very much. Very clear explanation there. A couple of questions on immigration type issues. First one is, how do you see Brexit affecting future immigration rules? And if you have a view on it, when would you anticipate those changes actually happening?
It's always it always comes down to a Brexit related question. Well, obviously, Brexit has taken place, and we've got transitional provisions in place for EU migrants or EU citizens. We are expecting that the free movement rules, the transition provisions that apply to EU citizens, will come to an end by the 31st of December 2020, so the end of this year. And we are expecting that there will be a new immigration system coming into place from the start of next year. And we believe that it will be possible to start applying under the new categories from the end, towards the end of this year. I think that it will possibly open up, possibly, and I'm speculating here, that it may open up some new visa categories and it may make it a bit more competitive. But for non-EU citizens, I don't see that Brexit itself will have any impact on the immigration options to them.
Great. Okay, thank you. And the second question on immigration topic, and I suppose it's really more from your sort of family office perspective, given how many Russian youngsters study in the UK. Are there any changes to the student visa requirements given the COVID-19 pandemic situation?
There are some concessions that are available in, or the Home Office have made several or numerous immigration concessions, but specifically for those who are here on a Tier 4 student visa. It is possible to sort of study from home or for not physically in the university campus itself, but I don't believe that the concession applies to new visa holders or people who are coming for the first time on the Tier 4 student category. And that's just sort of the COVID related concessions. There are other more broad sort of removal of restrictions for the time being for the Tier 4 sponsors themselves in terms of the reporting requirements. And I would add that non-COVID related, but I think it is from next year or the year after that, there will be effectively a resurrection of the former post-study work visa, and I believe it's called the graduate visa route, which will be introduced, or the Home Office say that will be introduced, I think it is next year or the year after, and that's effectively a 2-year visa sort of post-graduation that will allow the individual to seek employment opportunities in the UK.
Okay, thank you very much. I think we've got time for maybe a couple more questions. This one is again on visas, and it asks, do applicants of the innovator startup visas have to pay for the NHS health surcharge fee? And if so, is it calculated differently to other types of working visas?
Yeah, I should have mentioned that, apologies. Yeah, for each visa category, it's for each visa that's valid for 6 months or longer, it's necessary to pay for the immigration health surcharge. That's currently charged at £400 per year of the visa per person. So for a 3-year visa, you're looking at £1,200 per person. So the main applicant will be £1,200. Each dependent will also be £1,200. For an innovator visa, it is, you're applying for a 3-year visa, so it'll be 3 times £400. The immigration health surcharge is due to increase, I believe, from October of this year, and it's going to be just over £600 per person per year of their visa.
And that increase, Vincent, to 600 from 400,
yeah.
Does that apply for anybody that's already here, or somebody that applies now for their visa? It would be based on the £400, but if somebody applies after October, would be £600.
Yeah, so it will apply to everyone, I believe, that will be applying for either a new visa or an extension visa. So if you apply for a visa today, you'll pay the immigration health surcharge as at today's rate, which is £400 per year. If you then extend your visa in 3 years' time, you will be paying the higher rate or a lower rate if it is reduced, but you will be paying for the immigration health surcharge as at the date of you applying.
Right. Okay, thank you. And a final question, really testing your political skills here, I think. What are you telling your clients with respect to increase in tax rates in the UK to help finance the COVID relief package?
Well, interestingly, we're expecting a sort of a mini budget today. The anticipation actually is not so much in terms of increase of tax rates, but actually some cuts to specific sectors. I think one of the things that we're due to hear is an announcement in terms of a temporary suspension of our stamp duty, which is a tax on the acquisition of property up to certain levels. I think longer term, it's no secret we went through a period of quite severe austerity in the UK, and there seems to be some political will not to return to that. I think inevitably, and it's the same everywhere in the world, that the COVID situation has placed a huge burden in terms of UK PLC on our finances. I think inevitably there will be some hardening of the tax rules in certain targeted areas. I think anti-avoidance is one area that's already been stepped up a lot, and I think those measures will continue in particular. I think, quite frankly, it depends on whether or not we end up having a change of government. Obviously, the Conservative government have effectively another 4 years plus to serve, and I think whilst we have a Conservative government, I feel that the trend will largely be against large tax increases. If we have a change of government to a Labour government, whilst it's probably not going to be quite as stark of a contrast as it would have been under Jeremy Corbyn's leadership, there definitely will be a move towards an increase of tax burden I think the non-dom status potentially comes under threat if we have a change of government, unfortunately, from my perspective. And I think, you know, there possibly could be introductions of wealth taxes and those kind of things. So it's difficult to tell, but I hope with a Conservative government we will remain a relatively low tax and relatively tax friendly jurisdiction. But in the coming years, if there is a change, then certainly I see the tax burden increasing.
Right. Paul and Vincent, I'm afraid that's all we have time for. Thank you very much for a really interesting and engaging talk. And thank you to the audience as well for all your questions.
Yep, thank you.
I think there was a wide range of really good questions there. So thank you for your contributions. As I said at the beginning, this webinar will be posted online. So if you want to go back over any of it, it will be there for you. And also we'll make the presentation available should you wish. Dixcart have very kindly allowed us to do that. Finally, just thank Paul and Vincent once more. Thank you. We would love to do this again sometime down the road if you're up for it. Just make you aware of our next webinar, which is next week with Manpower, when we'll be looking at some of the HR issues that are arising from the COVID situation.
Great.
Thank you very much, and look forward to seeing you again next week.
Thanks all.
Thank you, Paul. Thank you.
Thank you. Bye all.